Howdy, Jacob here. Today we're looking at the company Lululemon, company 70 in our ROIC screener, 59 billion market cap on just under 58 billion enterprise value. Growth has been stupendous, with their lowest revenue growth being 10.6% right after COVID. Return on invested capital, absolutely amazing, in the low to mid 20s. Fantastic balance sheet. They have 1.2 billion cash on hand with no long-term, no short-term debt. Again, amazing balance sheet. Cash flow, decent cash flow, not as great as some of the other things we were looking at. Their use of cash is a little bit of acquisitions, a little bit of reinvestment, well, quite a bit of reinvestment actually. We see 100 million over here, 639 in capital expenditures here. Capital expenditures can really be your to just maintain the business, but also growth for expansion. And we are seeing a heavy amount of share repurchases. So it looks like almost all of the money that they make, probably 90+%, goes towards share repurchases. In the past, that might have looked attractive, but you got to be understanding that they're repurchasing shares out of 60 PE. Can they keep this growth rate? If they can sustain 15+% revenue growth and keep their earnings expansion and such over the next 10 years, then it's fine. There's a deflation in PE, but the growth outweighs it, and you get a return that's very close to what the business gets. But if it dwindles down to high single digits, then I don't see a way in which the PE doesn't deflate to something closer to the 20 range. And then once it does, I just see it being you know, you can have a fantastic business and not have a great investment. And I think we'll do the calculation right now, my estimation on free cash flow and earnings. But I mean, I'm just seeing 58 P in price to free cash flow. I'm not quite sure how much bigger this company can get. I know it's fantastic. I've heard great things from people that have it, but I also know people that buy Fabletics and they say that it's the same. So you have people that say it's the best. Have people that I do think there's a moat here. I think they are charging for a lot more than other companies are, and people are still paying for it. So that literally means it's a moat. But sustainability, I don't know. I kind of question sometimes. So I'll put in my assumptions here. I think for revenue growth, I'm probably going to go to 10% a year for the next 7 years. I'll say that at the end of this time period, maybe they still have a bit of growth left. I think 20 is more than impressive for a company that has grown 10% a year over the next 7 years. That could mean 15% the next 3 years, 8% after the next couple. It just means these are estimations. We're doing our best to project out here. And then on the margin side, I'll probably do pretty close to averages here. Let's do maybe 14 and 12 with a 2% buyback of shares. And as expected, I mean, I just think it's a little bit expensive. No surprise there. I think the PE is very inflated, and I think it's going to be coming down. I think if you understand this business and think it's going to grow beyond the discount rate that you are desiring for your return, then I do think you will get I do think it'll be a good investment for you. But for me, I'm looking for pretty excess returns, and I just don't think that this company at this price is going to be giving me that. Hope you enjoy the video and have a great rest of your day. Thank you so much.